Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Countdown to CPI data. Will disinflation stall as Wall Street remains divided over just how aggressive the Fed will be in cutting next year? A fentanyl crackdown is coming. Biden and Xi are set to announce a crackdown on synthetic opioid when they meet in San Francisco tomorrow. And the IEA says global oil markets won't be as tight as expected this quarter. We speak to the influential energy expert Bob McNally. Very good morning. We have breaking news coming in from Germany. This is on sentiment. The ZEW investor expectations rises to 9.8 from 5. So let's just see, does that inject a new boost into the euro? You're trading at 107.19. Of course, the dollar has had a nice rally of late, but this is the euro dollar this morning, up 0.2%. Have we passed the nadir of negativity in Germany? We'll leave you with that thought. Euro dollar trades at 107.19. The question for the Fed, however, in the bond markets is, and we know that the Fed is wary of head fakes, is the disinflation story. That's the key. CPI today. Has the CPI disinflation stalled? Yields drop ever so slightly, 4.61. This as it's going to help understand where the Fed's tightening bias is. By the way, going into these numbers, Bank of America's poll says we have the biggest bond overweight since 2009. The survey added 18% month on month. That takes the long position to nearly 19%. So the investor playbook for 2024 is a soft landing and lower rates. By the way, UBS just added to the controversy yesterday. 275 basis points of easing in 2024. I mean, that's got to be a heck of a hard landing for that. Dollar yen, yesterday we made a real big furore out of trading towards a 33-year low. But the risk for dollar yen is that you get a hotter CPI in the US. That emboldens the hawks and the hikes. 151. 91 is where you want to keep an eye on. By the way, Japan Suzuki overnight jawboned the market as well there. And they will take appropriate measures wherever necessary. Oil is just giving a little bit back this morning, which is breaking off trend. The OPEC demand, brilliant piece from OPEC, says we've got overblown negative sentiment, Danny. There you go. Overblown negative sentiment. And it's all the fault of the speculators, if I'm not wrong, according to one or two of the biggest protagonists in OPEC. Danny.
You sound like the bulls talking about this equity or stock market. We have a pretty nice pre-market rally so far this morning. Can it last into today's CPI numbers? You'd assume that this equity market is looking for something on the cooler side. But nonetheless, S&P and NASDAQ futures both up about 0.2%. NASDAQ outperforming ever so slightly. Marko Kolanovic still not changing his bearish tune, as you'd maybe expect, saying the recent rally we've seen is just positioning. It is just short covering. You want to back off of this equity market and pile into commodities. Now, the focus might be on tech this morning with its outperformance, but it's going to be retailers throughout the week. We get Home Depot today, followed by Walmart, followed by Target later in the week. Finally, European stocks, those charting higher this morning too, Manus, up 0.2%. The best performing sector is miners, thanks to Glencore buying a majority stake in tech for just under $7 billion. So those shares up sizably this morning, again, helping the overall European market rally. But Manus, when it comes to the stock market, we have a new call from Ed Yardeni. He sees stocks finishing at 4,600 by year end and sees a new record by 2025. He wrote in a note to clients late yesterday that the vigilantes are clearing the way for the stock bulls. In other words, that since the bear market ended, he thinks it ended in October 2022, that it's entered a new bull market. Now, the bond vigilantes and their concerns have retreated. And this is, again, his call of 4,600 by year end. So, Manus, there you have it. The man who coined the term bond vigilantes thinks that they're done now. He thinks they're gone.
He thinks they're gone. But that would tie up with the Bank of America survey, wouldn't it? Which is that they stacked up and racked up pretty significant long positions over the past month. So if we're no longer worried about deficits, we're no longer worried really about the pillars of stability in the bond market. We've got that investor playbook set. Bank of America poll, they're the longest they've been since 2009. It was a tricky year in 2009, just for anybody that forgot it. Danny, let's talk about the markets, because we've got the latest read on American inflation, as we've been saying. This is what we're set for. How much progress? We're looking at a plus 0.3% on the core, so the consumer price index, excluding food and energy, plus 0.3% for a second straight month in October. That leaves your year-over-year rate of 4.1%. That is the stage. Let's bring Andrew McCaffery into the conversation, Global Asset Management CIO at Fidelity. There we go. The assumption is for this disinflation narrative to run out of steam. But I look at the positioning in the bond market, the longest they've been since 2009. So is that the bond market getting out of ahead of a flat piece of data to say 2024 is a year of disinflation? Let's be wrong, let's be long and stack it up.
So I think on that, Manus, that what they're really saying is that they're going to look through this data again and look to where they feel the trend really is going. And that is that we are seeing that signs that the major peak has occurred, that now we've had a secondary period of small upswing, but that will be looking to decline as we go into 24. And also that the Fed is looking through and looking across a range of data, and some of those data points definitely point to a slowing economy. And so, again, as we see them tot up everything, that we will have a little bit of support, but it won't be necessarily just looking at today's data.
And meanwhile, the majority of market commentators continue to say it's a soft landing. Even some banks like Morgan Stanley see a lot of cuts, but still think it's a soft landing. You not so much so. Your framework is 60% odds of a cyclical recession. What does a cyclical recession actually look like?
So I think that's where we see a notable uptick in unemployment. So somewhere in the region of 4.5 to 6.5% developing over the course of 24 to 25. Now, I think the difficult part is timing. So, we're in that it comes further into 24. So we're actually in a very interesting period where the markets can respond to potential in a Fed rate peak. You can see earnings staying reasonably robust, see the economy move from a red-hot basis to a more moderate one, and actually trade for those slightly better outlook in the interim. But as we go further into 24, the risks start to pile up as the transmission mechanism and some of the indicators we're seeing now that are rolling over become more relevant to the market.
So cyclical recession, the risks pile up. Could you then see your way to, if I look at those three houses that have come out with their calls, UBS is going for 275 basis points next year in the space of 8 months. Could you see something as dramatic as that? Lumpy, large size, off the norm 25 basis point cuts in the scenario of a cyclical recession is a 60% case for you?
So we think unlikely, Manus, that we do see that cuts will come through, but I think that the only reason that you would see something as significant as that is if you see really that marked increase in unemployment accelerating at the time that we really do have signs that the inflation level is staying and getting close to that 2% area that the Fed is targeting, and that can be sustained for a period. We think that the reality is that's unlikely to be seen through the course of the second and third quarters. And so to get that level of rate cuts, it still seems unlikely to us.
Okay. It's interesting because a lot of folks out there in the market right now haven't been trading in that sort of environment where you're heading into a recession, but you still have that inflationary environment, which means you can't cut as much. Equities have been really sanguine throughout this whole drama, even as the bond market predicts cuts, which would, again, be something much worse. So once we get into that environment you're talking about in 24, where things start to turn, what actually happens to this equity market?
Well, I think that this really comes down to if earnings stay the way we have seen, which has actually tended to be more robust than many expectations, and that stability does continue, then equities can do reasonably well. But again, we have to look at what's already happened. The reality is that most of the equity market has not performed that well. And that it's been the Mega 7 that have really led everything through the course of the rally. And again, are impacting now. And it's very interesting that they are almost behaving like a safe haven sort of trade in themselves. So I think that they will be an important part as we go into the early stages of 24. The challenge is, as we start to see unemployment rise, that as we see some of the consumer activity starting to roll over from that, as we see signs as well that inflation doesn't necessarily dissipate dramatically, but does continue to hold steady at lower levels, then the Fed will respond to those factors. And I think the equity market really only becomes very vulnerable if you see those earnings numbers start to turn over more radically. And it has to come in the Mega 7 as well.
Right.
Well, let's face it, they've been able to price, a lot of companies have been able to price themselves up. Now, I like your scenarios that you put forward for China. Control stabilization, it sounds wonderful, but to that extent, how do they deliver controlled stabilization? Xi and Biden meet today. We'll talk more about that in a moment. He arrives not with a very strong hand. What is controlled stabilization? And more importantly, does that mean that you live with more China in your bucket allocation or less?
So really what we're looking for is that the combination of monetary policy and also elements of fiscal policy that continue to focus on stabilising where they see levels of high risk, obviously the property sector, but also supportive across a number of different sectors. And we've seen actually within the Chinese economy a very vibrant technology base, which has also been very, very clear in terms of electric vehicles, in terms of green technology as well. But that's really broadening out. And what they're really trying to create is a level of confidence back into the domestic, corporate and individual environment.
Andrew, I love it. You're bucking the China pessimism and the U.S. optimism. Really great to get your thoughts this morning. Contrarian as ever, Andrew McCaffery of Fidelity International. And of course, Manus, we're going to be getting some retail earnings on the deck, too. So that will be interesting to see. But in the meantime, let's get to some of the other top stories that are trending on the terminal this morning. ICBC, the world's largest lender, flew top executives to the U.S. in an effort to contain the fallout from recent cyber attacks. The bank is investigating the incident, but has not announced when access to systems of its offshore unit will return to normal.
President Biden called on Israel to take less intrusive action at the Al-Shifa hospital in Gaza, stepping up pressure to reduce civilian casualties. Israel says Hamas uses hospitals as the basis for its operations.
Now, Bloomberg has learned that China plans to provide at least $137 billion of low-cost financing to the nation's urban village renovation and affordable housing programs. It's the latest effort to shore up the struggling property market.
Coming up, as President Biden and President Xi prepare to meet, we discuss the global issues surrounding the two largest economies. That's next.
And later, we're going to be speaking to Bob McNally, founder and president of Rapidan Energy, on oil's relief rally and the latest comments from OPEC on Bloomberg.
We did talk about the slowdown in the Chinese economy, and I think agreed that it presents a downside risk to the economic outlook that could affect probably not so much the United States, but many APEC economies that have deep trade relations.
Treasury Secretary Janet Yellen speaking at the press conference for the APEC summit in San Francisco. Now, at that summit, President Biden and his counterpart Xi Jinping are set to announce an agreement that would see Beijing crack down on the manufacturing and export of fentanyl. Joining us now is Roz Matheson. Roz, what exactly are we expecting from this fentanyl deal?
Well, it looks like China will agree to try and halt the supply of fentanyl and its source material, which is going mainly through Mexico and into the U.S. and, of course, as we know, causing a protracted crisis, health crisis in the U.S. And China has resisted for many, many months the idea of cracking down from the source and the accusations that, in fact, they are the source of some of this fentanyl. But it sounds like Xi Jinping will at least make a promise at this meeting with U.S. President Joe Biden to try and curb the supply of fentanyl into the U.S. How much much in reality China can even stop the supply itself remains to be seen. But the promise itself is important because it will give US President Joe Biden a boost going into the US election campaign. Of course, he's promising to try and curb fentanyl use to improve this health crisis in the US. And so for Joe Biden, it's quite a win to get this promise, at least. Again, how much it translates into reality would remain to be seen.
Ros, good to see you this morning. I was looking at the New York Times. In 2015, he wrapped his demands for respect and reassurances. He quoted the tech executives while defending China's interests, and he denied that they were militarizing the disputed South China Sea. My, how things have changed. He's not arriving with that very strong economy behind him at this juncture. What is the tail risk for traders here? Is there a tail risk that there could be a floor on tariffs, that there could be an incremental move on tariffs? What is the biggest risk for traders on the outcome here?
Well, the biggest risk, I guess, for traders is that there's not a lot of tangibles out of this, or that any goodwill that we see from this meeting proves to be very short-lived. As you're saying, right now, there's an incentive for both Joe Biden and Xi Jinping to improve the relationship, at least stop it from getting any worse, and sort of clarify the business environment in particular for both Chinese companies and US companies, so that Xi Jinping can improve his economy. And of course, Joe Biden's got an eye on the election, but there's a lot of other factors at play. And so the question for traders is this a true flaw, an established flaw, or does it dissipate pretty quickly after the San Francisco glow of their meeting?
And, I just wonder how much of it can come out of things like oil, for example. Manis and I are going to be catching up with Bob McNally later. And, of course, China relies a lot on Iranian oil. And the U.S., it didn't pursue sanctions or tougher sanctions as many thought they would. There's some real big sticking points here, despite, again, trying to get a more positive mood music to come out of the meeting.
Well, that's why we're probably going to see sort of issues around where they can have shared goodwill and a common interest. So fentanyl is an easy victory for the Chinese to give. They've been buying soybeans again from the US, an easy goodwill gesture to make. Perhaps you get some things around Boeing, you get some stuff around climate change, common global challenges, but the real hard stuff, that's still off the table. So we're talking technology, some of the issues around trade and business, where it's very, very difficult to see a lot of movement, because Joe Biden arguably has been a more protectionist president than Donald Trump, just perhaps in a politer way with China, and he's got no great incentive to dismantle all of that now. And so, all those difficulties around trade, technology in particular, oil, as you mentioned, those are probably going to go into too hard box for this conversation. It's really about, can we have some short-term gestures and put a floor under the relationship?
OK, Ros, thank you very much. Ros Matheson there with the very latest. Let's see what San Francisco brings for us. And it's interesting, though, isn't it? Because you look at the kind of commentary, Danny, that's come through from Martin Malone. And I was fascinated in the WhatsApp this morning from Oil Group. You've got Xi Albanese. You've got Xi Biden. Cameron's back on the world stage. Is this a November global reset?
And we were just catching up with Andrew McCaffery of Fidelity International. During the break, as he walked off, he said to me, one thing we didn't talk about is that there is a potential for further goodwill to come out of this meeting. Perhaps Biden announces a tariff come down, a rollback of some of the Trump-era tariffs. This is underappreciated, Andrew said, by the market.
And maybe it's under position for that. If you just look, again, go back, you got Xi Australia, Xi USA, Cameron back on the stage. I don't know. I don't have an opinion on that. That's for greater minds than I, but he's back on the stage. Xi and Kishida. What if Kishida meets later today? So this is about a fundamental reset, which is critically important for the 2023 growth story, which has got implications. OK, whatever China does may not have a huge impact on the US growth story, but it will have everywhere else in the world. Quick snapshot of bonds. CPI countdown to flatline disinflation. This is what we've got. The bond market is as long as it can be. Yields fall ever so slightly, 461. Do you want to be long duration going into the CPI today? Core expected at plus 0.3%. Disinflation runs out of puff. Good morning from New York. Good morning, London. It's Bloomberg Brief. I'm Manis Cranny in New York, Danny Berger in London. It took 20 minutes. It cost $47 million. It's not your Christmas present. And the commission was 10%. What are we talking about? The Ferrari. It's a thing of beauty. This was auctioned at Sotheby's, Danny. 20 minutes, and it went from 34 million to 47 million bucks. 1962 330 LM.
Yeah, not too bad. This is a steal, man. Sure, it's the most expensive car ever sold, but 51.7 million. The expectation was that it would be in excess of $60 million. So whoever bought this thing, man, has got just an excellent deal.
They got a steal. Andiamo ragazzi. Francine would be proud of me with my Italian there. I think there was a Mercedes. There was a Mercedes. I know, it's dreadful. All the Italian viewers can now email. Ciao ragazzi. Yes, I've been to Ravello once. There was a Merc. There was a Merc that was sold, a 300 SLR back in 2022, and that went for $142 million. But I think this one, I've got some facts. This actually was raced by, now I'm going to crucify this man's name, Scuderia Ferrari. There you go.
All right, you're never allowed back into Italy. I think that's what just happened.
No more pasta.
Okay, so Ferraris are hot. Watches are not. Long Ferraris, short used watches is the trade. Manus, used watches, according to the Subdial Index, is at the lowest in 2 years. So there you go, Manus. You can finally buy me that Rolex you've been looking at.
I wasn't thinking about you. I was thinking more about myself. So, but then, you know, I always comes before us. There you go. There's your Rolexes. What do we see? The Subdial Index. So Rolexes are down 27% from their peak. You've got the overall index is down 42% from the peak, and Patek Philippe down 47%. What do you want for Christmas? You can say me and a Patek Philippe. You know, you can say both.
Yeah. I'll take that super rare Patek, Manus. Thank you very much. Going for what? 90,000? That's a steal compared to that $51 million car.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Countdown to CPI data. Will disinflation stall as Wall Street remains divided over just how aggressive the Fed will be in cutting next year? A fentanyl crackdown is coming. Biden and Xi are set to announce a crackdown on the synthetic opioid when they meet in San Francisco tomorrow. And the IEA says global oil markets won't be as tight as expected this quarter. We speak with influential energy expert Bob McNally. Now, for this equity market, we are waiting for CPI, but we're not waiting to buy. Both futures on NASDAQ and S&P are charting higher this morning, up 0.2 for S&P, 0.3 for NASDAQ 100 futures. We're just speaking with Andrew McCaffery over at Fidelity, who says even if we enter a cyclical recession next year, stocks can hold up because small caps have already sold off massively. It's the Magnificent Seven that's been supporting things, and balance sheets look strong, almost a quality play at this point. European equities, those move higher too, up 0.2%. And Manus, that's because the mega deals are back. We have Glencore buying a majority stake for just under $7 billion of tech. Those shares moving higher this morning, supporting the overall European equity index.
At least somebody's feeding the investment banking fees into the close of the year. You know, the sweet smell of a deal fee. Cyclical recession, 60% probability from Fidelity. But having a look at what's happening is the Fed's starting point is, look, we're wary of head fakes. That's why today's CPI data is important. Disinflation. CPI likely stalled. That'll reinforce the Fed's binding bias. As we go in, you see yields drop ever so slightly. Bank of America's survey has the biggest overweight on bonds since 2009. They've added nearly 18% to their exposure over the past month. So that takes them to a net long of around 19%. Now, UBS, of course, yesterday, they said that they expect 275 basis points of cuts to come through. Dollar yen dips ever so slightly. We're still 20 basis points away from the 33-year high. You've got the finance minister out overnight warning that they're ready to intervene. So a lot of jawboning going on there. That's Mr. Suzuki in Japan. Brent manages to put on a 0.25% in 30 minutes since we last spoke. But, of course, the OPEC report says, and we'll talk more to Bob about this, that the demand outlook is overblown with negative sentiment. But if it's Thanksgiving, and we know it is next week, you're going to be driving. It's going to be the busiest since 2019. I haven't got my American driver's license just yet. Danny.
Well, see, Manus, it's perfect because I don't have my UK driver's license. So you can visit me, be my chauffeur, and when I'm there, I can be your chauffeur. It works out perfectly.
See, I can steer and you can change the gears, or you can change the gears and I can steer. It depends which way you want to control the show. We know who controls this show, Danny Berger.
That is not true. We are both equal co-pilots. Okay, Manus, can we move on to oil? Because I feel like I'm going to get myself in trouble here. All right, the IEA says that global oil markets won't be as tight as expected this quarter. It boosted its forecast for fuel consumption. The head of the oil market division spoke to Bloomberg earlier.
We are seeing some signs of demand destructions. As I note, China and the U.S. has held up relatively strongly despite the economic outlook, but we're seeing signs of slowing demand, especially in Europe and also in OECD Asia Pacific, where in the third quarter demand fell by more than 500,000 barrels a day.
Let's bring in Bob McNally, president and founder of Rapidan Energy Group. Bob, we'll give you the keys. You can drive the show for now, because this is something that you pointed out in your note. You talked about this idea that you have the IEA there talking about oil markets less tight than expected, but OPEC has their doubling down of their big deficit call. That is a big divide. Where does the truth lay?
Well, it is. How unusual it is, Danny. Here we are halfway through the fourth quarter, and you've got the EIA saying we're going to have a small surplus this year. You have OPEC saying, no, we're going to have a 3 million barrel a day monster deficit. And now the IEA this morning coming out sort of toward the EIA saying it's going to be about a 900,000 barrel a day deficit, smaller than we had been expecting. So that's an unusual spread between official agencies. The truth is probably somewhere in between. That's where Rapidan has been. We'll probably be a little lower than we were last month, but the truth is probably somewhere in between. Look, here's the deal. What you can't argue with is that inventories have not been drawing by as much as folks expected, many analysts expected. That is the case. In the third quarter, we had big crude draws, but products were up. So far this quarter, we're seeing both crude and products draw. The question really is stocks at sea is kind of a foggy area, so we don't really know. But it's unusual uncertainty and differences among the official barrel counters this quarter.
So with that level of discrepancy, a lot has got to go wrong. I mean, it's an awful phrase, but an awful lot's got to go very, very wrong to end up with a deficit of 3 million barrels. But I'm not a PhD mathematician. The question is whether this brutal 12% sell-off, I know we've turned a little bit around in the past 24 hours. Do you think we're closer to a floor in this oil market at Brent at $82, but NYMEX sub $80? Or do you think there's a little bit more, let's say, weight to go on the downside?
We think we're constructive, Manus. I think crude has more upside risk than downside risk here into the end of the year. I think the macro bearish narrative for oil has been overdone. As the IEA said this morning, demand continuing to exceed expectations. China in September topped 17 million barrels a day, a new record high. So the market has been climbing a wall of worry about macro when it comes to oil. What has been surprising is on the supply side, you have seen stronger U.S., stronger Brazil, Guyana. So you've seen a little stronger on the supply side. So maybe we're not as bullish as we were before, but we're constructive into end year, Manus.
So tell me then, Bob, do you think the Saudis will extend their 1 million barrel cut into next year?
I think odds favor them doing so. We had been expecting them tapering the cut in the first quarter, so withdrawing it gradually. Now the odds are probably toward a little longer of an extension. Why? The speculators are coming back. Minister Abdulaziz bin Salman does not like that. He said that publicly. Balances are a little softer. And look, it's clear Saudi Arabia is not basing its oil policy on the OPEC balances. If they were, they wouldn't have cut in the first place. So I'm not sure they're as confident as the OPEC barrel counters in these monster deficits. So I think they'll take a little more of an insurance policy out in the first quarter by extending the cut.
Bob, you can't come on the show and say, I'm constructive on oil to the end. You have to give me a level. You have to give me a bandwidth. You're not getting off the show with that. So come on, give us a constructive price.
I think we're going to be well into the 90s by the end of the year. I think the market's a little complacent on geopolitical risk. Gaza, everyone's forgotten about. It looks like from options, the price risk is zero. It's not zero. It's starting up with Hezbollah and Iran's proxies. That risk is not zero. We're not saying there's going to be a major oil disruption, but the risk is not zero. Also, look at the G7 is starting to crack down on the price cap. The Treasury just sent out letters to 30 countries looking to crack down on importers of Russian oil. So we're not done with geopolitical risk. And so I think between that and fundamentals, we'll go higher into the 90s, Mandis, by Christmas.
Can there really be a crackdown on Iranian oil, for example, Bob? You have Xi in San Francisco with Biden right now. China is very reliant on Iranian oil. They're trying to get to some sort of agreement. Where does the future lay with sanctions in Iran?
So when it comes to Iran, the Biden administration doesn't want to mess around with sanctions. Why? Because if you start to crack down on Iran's oil exports, they will go back to enriching nuclear activities, and that will raise the overall threat level even higher. So the Biden folks, I don't think they want to touch sanctions on Iran. Congress wants to do that. I'm not sure the Biden folks want to do that. With Russia, it's okay. They'll take some risk, but not with Iran because of the nuclear weapons stuff.
Well, Israel has nuclear weapons as well. We don't have enough time to go down that road. The market is in backwardation. Your good nation is refilling the SPR. Contextualize that for our markets and what you understand about what's going on. Maybe that's the floor, Bob. Maybe that's the tacit agreement between Washington and Riyadh, which is you hold on to your 1 million barrels a day. You can even extend your lollipop. And you know what, guys and girls? We'll do a little bit of SP or filling. Is that a pro quo that works for you, Mr. McNally?
Well, first of all, this is man bites dog. Consider the Biden administration, to its credit, is filling the SPR with a war in the Middle East and oil prices still around $80 a barrel. That's pretty incredible. Shows how low the SPR has gotten. They really want to refill it. But no, I don't think there's a quid pro quo. We're filling the SPR at about 100,000 barrels a day. The Saudi cut was 10 times as much. So I don't think you'll see a quid pro quo barrel for barrel. But I think Riyadh is happy that the DOE and the Biden administration is starting to refill the SPR. I think that helps with the mood music, but there's not a strict quid pro quo.
Well, size matters, and that's where Saudi has it. You know, 10 to 1 ratio on the SPR. Danny. Bob, thank you very much. And he even gave us a price. You can come back. Bob McNally at Rapidan Energy Group.
Well done, Bob.
And getting up early for us. Danny, OK, what have we got? We have a little bit of a shutdown showdown. The House Speaker Johnson turns to the Democrats with his plan to avert a government shutdown.
This is Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. After only a few weeks in the position, House Speaker Mike Johnson is being put to the test and must try to work with Democrats to avert a government shutdown. Joining us now is Kevin Whitelaw, Bloomberg editor who's covered Washington for 25 years. So, Kevin, there's this planned vote today on his temporary funding proposal. What's the expectation for how this goes down?
Well, I mean, I think everyone's still, in a bit of suspense over exactly how it's going to play out. The measure that's that's on the table is a relatively clean spending extension, but it doesn't include any money for Israel, doesn't include any money for Ukraine. And it has a strange sort of two-tier deadline system. It expires at 2 different times for different parts of the government next year. But it doesn't include any of the steep spending cuts that Republicans were demanding. So the far right doesn't like it very much. Democrats are a little uneasy about it, and everyone else is a little bit puzzled. Having said that, I don't think anyone wants a shutdown right now, and this may sort of be the best way just to sort of delay some of the pain until early next year.
And then, of course, we've got this red headline this morning. The EU is weighing extending its steel trade truce with the US to avoid tariffs. It seems as if there's a shift in global geopolitics, isn't it, in the past sort of 24, 48 hours? Xi, Biden, Cameron, here we are with the EU. There just seems to be a new step change, doesn't there, in terms of the movement? What can you tell us about the EU suggestion?
Yeah, I mean, I think in this case, the EU has really been signaling for a while that it doesn't really want a return to the tariff fight. It doesn't really can't really afford that right now. It doesn't want to have that kind of trade battle in the middle of a time where it's still basically flirting with recession in a number of economies. And so I think what we're seeing is now a much more serious conversation about basically pushing out any threat of those tariffs returning to try to give these steel and aluminum talks more time. Obviously, the two sides, the U.S. and the EU, are unable to reach a deal in a summit that in D.C. a few weeks ago, and it really sort of showed they're not that close to it. They're going to need more time, and this seems to be the best way to buy that time and to try to get past this this fight, which really neither side is looking to have, particularly ahead of the U.S. presidential election next year.
Okay, Kevin, thank you very much. That is Bloomberg's Kevin Whitelaw. Let's turn our attention back to the U.S. and the data flow. The CPI data will come out in less than, 3 hours? So let's bring in our resident expert. It is Mike McKee for more. Differentiate for us, what am I going to be most upset about? People are saying disinflation will stall. Then I've got another narrative, which is that super core may pop a little bit higher. What are you going to be super focused on?
Well, I'm going to be focused on the market reaction because that helps drive the Fed. And I saw a headline that worried me this morning on the Bloomberg terminal. It says traders push stocks futures up as they anticipate inflation cools. The forecast is for inflation to cool, particularly at the headline level, and to be unchanged at the core. But what if that is wrong? What if the core actually rises? That's not priced into the markets. And some of the people who think that we could see a surprise today are leaning toward the idea that maybe on an unrounded basis, we get a three-digit rise to 3.05%. In terms of the core on a month-over-month basis, which would push up the year-over-year to 4.2, and that could really cause a concern. And here's one of the reasons why. This is health insurance. Once a year, the Bureau of Labor Statistics recalculates that. And you see how it was high for a year, and then for the last year, it's been negative and subtracting from CPI. This time, it is likely to add to inflation pressures at the core level. So there are some concerns that we could get a negative surprise today.
Mike, I do wonder about the inflation expectation, Jeannie. I know this is something you were looking at yesterday because we had those UMich figures which showed expectations rocketing higher. But then yesterday we get the NY Fed expectation reading, which was lower than expected when it came to the survey of consumers. How do you make heads or tails of these two conflicting reports?
Well, I suppose I would go with the Fed because it makes more logical sense. It's a little hard to understand the Michigan numbers, given that the Michigan numbers usually are tied to the price of gasoline, which is going to be a big reason that the headline CPI falls today. Gasoline prices down a lot over the last month. But this time we saw a rise for the second month in a row in consumers' expectations for one-year ahead inflation in the Michigan survey. And that doesn't make a whole lot of sense other than the fact that they've been reading a lot maybe in the papers about the idea that inflation is not going away, and they translate that to higher inflation ahead. The Fed is also watching the markets, and the markets are closer to the New York Fed in terms of their forecast for where inflation is going, and so that gives them some reassurance.
You just mentioned gas prices there, and I've come to live in America. I don't have a car yet. I don't have a driver's license.
Don't get one.
Well, no, but I have driven from here. I have driven from here to North Carolina. It's a long drive. But on that, we're going to have one of the Danny brought this up. We're going to have one of the busiest driving seasons for Thanksgiving we've had since 2019. How important is this gas price to the overall consumer health? We're seeing savings drop off. Gas is critically important for the pocketbook, isn't it?
It is. And when gasoline prices go up, people get very depressed about the economic situation because it's something they see every day. They go out and they put gas in the car and they can see on the pump how much they're paying, and that takes away from other areas in which they can spend money. But the biggest thing that happens is people look at gas prices and get upset when gas prices go above their previous high. And we haven't seen that, and now we've seen a big turnaround in gas prices, and they've come down a lot. So the question going forward, and we get retail sales numbers for October tomorrow, is does this mean people will feel they can spend more money for the holiday season? That's going to be an interesting question that retailers are going to be asking. We get a lot of retailers reporting over the next few days.
We have Home Depot afterwards. Don't worry, I've helped them out. I've spent a few dollars.
Yeah.
And so what is their forecast going to be? It'd be interesting to see a store like Walmart, which sells gasoline, and how much of that they think will move from the pumps outside the store into the shelves inside.
Yeah, it's such a good point. Home Depot today, then we're going to get Walmart and Target later in the week. A lot between the eco data and the retailers. Mike, thanks so much. Michael McKee there with your little CPI preview. Now, coming up, we're going to have a little preview of what's ahead in the next 24 hours, some of the market-moving events to watch throughout the day. Manis.
Well, do we get obsessed by this CPI, Danny? Do we look through it? That's what Fidelity's view was. Strong profits, strong earnings. Let's have a look across your assets this morning. CPI, we're counting down. You've got S&P futures up 0.6%. Again, you are just seeing the dollar index flat at the moment. 10-year yields drop ever so slightly ahead of the CPI. Plus 0.3% is what we're looking for. Will we see disinflation flatline? Good morning from New York and London.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Let's get you set up for your trading day with a look at what's ahead. The big event, U.S. CPI, 8:30 a.m. Eastern. The estimate is for 0.1% month over month, 3.3% year over year. Both of those would be down from previous readings. Then a host of Fed speak, followed by the data. We have Barkin, Barr, Master, Goolsbee, and Jefferson. Jefferson actually just speaking moments ago, all on deck. And President Biden heads to San Francisco while the APEC ministerial meetings kick off the summit. And so, Manus, we're going to start with Home Depot today. Later in the week, we're also going to get Target and we're going to get Walmart. We were just speaking with Michael McKee about this. What does that tell us about the consumer and just how much inflation is biting or preventing them from spending on big ticket items?
Yeah, I mean, I've actually been, because I've moved here, I need to buy stuff, just classic kind of stuff. A new TV that works with a plug. You know, so I have been into some of these shops, into Home Depot. I've been into Best Buy, looking for a TV. What's the other one? Costco. I haven't been there yet, but you're seeing.
Haven't?
No, I haven't. I haven't found Costco.
You got to,
yet.
Manus.
I have found a few other clothes stores, but I haven't found Costco. But even on the sticker, on the bumper stickers, on simple things that I'm buying, like a vacuum, an iron, a TV, it's all 20, 30% off. So you're already beginning to see some discounts. I know it's the holiday season, and I know it's there, but, you know, let's see. In terms of
that just reminds me. Wait, Manus, this is going to be your first Black Friday in America. Are you going to partake? Are you going to line up for the deals?
You see, Danny, I'm actually going to see you next Friday in London, and I'm going to go to Vienna. But you see, you don't even track when I'm coming. I'm traveling across the world to see. We're going to be reunited together next Friday. Look, on a more serious note, it is pretty significant, these discounts. You know, I'm in the market for a bunch of stuff. What else do you want to watch? I mean, you got a towing cost, and you make this call. Do you want oil or euro?
What's moving more? Maybe euro? Let's go euro.
Well,
Why not? Strengthening
the ZEW
versus the dollar.
Yeah.
Yes, the ZEW. You broke this at the start of the show, Manus. Is it the nadir of sentiment in Germany? It just might be with these numbers.
And therefore, that's got a big impact in terms of what happens with the ECB. So the euro, we made a session high. That was at the start. Expectations, we've turned positive for the first time since April. So that is optimism or misguided optimism. I'm not really that sure. I'm an optimist.
Manus, I feel like that's good. You're an optimist. You're coming to visit me, missing the Black Friday deals. We'll go shopping while you're here. We'll go to Bicester Village. We can get something nice.
Bond Street, here we come.